It is officially 10 o'clock, and so I want to thank each of you for joining us. This is the third of a series of three webinars we are doing for the portfolio company as we try to adjust and figure out what COVID and pandemic and the New World Order means. This will be recorded and it will be shared exclusively with our portfolio companies and then broader as time goes on. But I want to thank my panelists and guests. So the objective here is to talk about fundraising and fundraising in the COVID world. As we talk about having capital come in and utilizing that capital, accessing that capital, and basically allowing our companies to survive or thrive. I'll share a couple of stats before we jump on because we have about 250 portfolio companies, and we've evaluated them in detail on a one-to-one basis. And I think it's good to get a sense for about a third of those companies have a very clear and immediate negative impact of the overall COVID epidemic, and about 10% have an overall positive impact, which I think is pretty surprising from my perspective, meaning their business, remote telehealth or online delivery or a whole host of other industries are positively impacted. And so I want to talk a little bit about how and what in a normal day we are working towards raising some capital. And I'm sorry, our portfolio are looking at raising capital, but the pipeline for each of you has got to be changed. And you know what? I'm already jumping in too far. I want to do a brief introduction before we get started. Sorry, I'm so excited to ask the questions. And so if you don't mind, why don't we go around? I am Scott Nissenbaum. I'm the Chief Investment Officer and Executive Vice President for Ben Franklin Technology Partners of Southeastern Pennsylvania. I do have four guests with me today. And maybe, Don, I'm going to start with you, but we'll just quickly go around and introduce ourselves. Donna, who represents the universe of angel investors on our behalf.
Yeah. Donna Cordner. I run a venture fund called OCAM Capital. We invest in digital health. And then I'm also the managing partner for Robinhood Ventures here in Philly, one of the biggest angel groups we have in the region.
Excellent. Thank you. And Q, according to the screen, you are next in line. So if you don't mind, give us a brief introduction and then we'll jump in.
Sure, Scott. Thank you. My name is Q. I'm with DNxVentures. We're part of the same Draper Venture network that Scott is part of. So you guys are all sister companies to us. And, we've just raised our new fund. That's a $300 million fund. We are a Series A investor and pretty much across all sectors that Scott invests in, we invest in. Thank you.
Q, you're going to be very popular. You're going to get 250 calls after this. Jay, if you don't mind, give us a little background on you and Wavemaker.
Absolutely. Thanks for having me. I'm a general partner at Wavemaker Three-Sixty Health. We're based in Los Angeles, is essentially the Southern California region's healthcare fund, doing healthcare only. And focused on the seed stage primarily, occasionally going a little earlier than seed or a little later than seed, but mostly seed and all healthcare.
Excellent. And then last but not least, we have both a banker and an investment banker, David Reed. David?
Hey, good morning, everyone. Thanks, Scott. I'm David Reed. I am the head of capital markets for Fulton Bank. And I assist entrepreneurs in raising capital as well as in executing merger and acquisition transactions. And thanks for having me today, Scott.
No, my pleasure. My pleasure. Thanks for joining us. So before we jump in, I want to do a quick commercial announcement to our portfolio that we are launching for a way to both communicate, collaborate, and share a Slack channel just for the Ben Franklin Portfolio Company. Probably should have had it for a while, but we are now fully embracing the use of technology and allowing the portfolio company through Slack to communicate. You'll be seeing an email shortly with that, and we would encourage you and hope that we can use that as a tool to support each other and communication with Ben Franklin. So why don't we jump into the questions? Thank you all for being here. I think let's start with pipeline. These are not normal times. I'm not sure there's any example, having lived through the dot-com boom and bust and the financial crisis and 9/11 and a whole host of other things, but this one is truly unique. And so how do you approach, sort of what you're doing from a deal flow standpoint, the type of deals you're looking at? If you don't mind, let's talk a little bit about, are you looking at new deals? Maybe we should even start there.
Well, I could say we're looking at new deals. We actually had our monthly meeting yesterday. We had, I think, 3 or 4 new deals that presented. And so we have a couple that are in due diligence. We're more selective, obviously, about what we're doing. I think that's the key. I think there are some transactions that might benefit from COVID. So obviously those would be more in a fast track. So a couple, I think 1 or 2 of them yesterday were had some COVID related applications. So those are more fast tracked. But I would say, yeah, we're, of course, I think deal terms, we can talk about that. Deal terms are changing and they need to change, but we're definitely open for business, just being much more selective about what we do.
Yeah. I think that there's, in some regards, I think maybe if you asked me this in 60 days, I might have a slightly different answer, but at least right now, and most of us represent healthcare investing, there's almost an opposite effect on deal flow. Healthcare is on the tip of everybody's tongue, and the quantity and source of companies we've looked at in the last 4 or 5 weeks have gone up, both quantity and sources. Everybody is now running into a healthcare company and thinks it's kind of cool to present that healthcare company to a healthcare fund in ways that was not happening. We have a very diversified or broad group of limited partners, as you know, Scott. So we already benefit from that, but our fire hose has not lost a drop in the last 4 or 5 weeks. And I just ran a report last night, just looking at statistically how many deals we've sort of entered into our pipeline and begun to process those investment opportunities. And it has not skipped a beat since late January, early February. So I think it's just because, the thing we do, the thing most of us are doing here on this call is healthcare. And it's the number one topic on everybody's mind. And it's not normally the number one topic on people's minds.
Agreed. Do you think the quality of the entrepreneurs, their preparedness when they come into you, do you feel like they're hitting you and saying, you know what, we're ready? Like we recognize what's at stake here, and the call it the motivation or the focus has increased? Think that's true?
I think that it in a binary, yes. So it's either very true or it's not, and a lot of it has to do with how much they're in the sort of eye of the storm of COVID. So we've got deals that really are neither positive or negatively impacted. They were a good healthcare company 3 months ago. They're a good healthcare company today, but they're not helped, hurt, or even affected really by COVID. But those that are COVID enhanced really seem to be coming in with and the word seems to have gotten out that if you're going to try to get healthcare venture capital right now, probably having a COVID theme to your story is a better way to move up the line than not. I think that's one thing that the world has kind of figured out. We've figured it out as a fund. It's a better investment, and it feels better. Just in terms of making the psychological statement that it feels better to invest in companies that are taking a big bite out of the COVID problem one way or another, whether it's telehealth, whether it's some kind of remote monitoring, whether it's a marketplace that keeps people from going to the hospital in the first place. All these things are net benefiting from the current situation.
And Q, you have a broad mandate like we do. You're not just healthcare. And so does that change the dynamic? Do you refocus on healthcare? How are you approaching sort of new deals?
Well, I think there are certain sectors, like Jay said, which have got wind behind the sails. But there are also other sectors besides healthcare. For example, a lot of robotics companies where you cannot rely anymore on human labor. It's not just a cost reduction anymore. So I think there are those that are, like you mentioned, collaboration and teleworking companies. But I'll just go back to the question you asked: Are we doing deals? And I think it's really important for the entrepreneurs here on the call to kind of separate out a lot of the public stances that VCs might take, whether it's on their Twitter or whether it's on their LinkedIn's, and honestly adjust their expectations. If it was taking, let's say, 6 weeks to make a decision or 8 weeks to make a decision, it's going to take 16 weeks. Just double it. If you were expecting, up rounds, flat is the new up. And it's just the nature of the times. If you're not expecting certain terms, expect them. Don't walk away from a term sheet because somebody put a term in there. This is becoming market, and that's what you accept. That we are tending to focus a lot more on pre-A and Series A, in a sense, because those companies are going to be spending the next 2 years building products, refining their go-to markets and things like that. So I think we'll, from a new fund perspective, at least, we'll probably over-index, some of that stuff. But people are doing deals, but you have to also understand, just like entrepreneurs, we VCs are also kind of trying to figure out, like, what are the signs? Is this like is this like a 2001 or is this a 2008? Do we need to wait 2 quarters? Our LPs are asking us the same questions that your board members are asking us. So just be patient with us. We will process, but this is not business as usual. I just want to separate out the public versus what's the stance in the family today.
Understood. And David, how does the bank approach credit in this situation? You're not making investments, but you're certainly supporting these companies. And are you allowing yourselves to go earlier, or are you going later because of it?
Yeah, let me address that, and also as I was listening to the other panelists, I was thinking about the M&A deal flow market and what we've seen there as well. So I'll make a brief comment about that, and then I'll address your question as well, Scott. So what we've seen with entrepreneurs who we were in dialogue with before the pandemic around transacting their businesses. This situation has moved almost all of those to the back burner, and they're moved to the back burner because there's a fundamental inability right now for an entrepreneur to, in many swaths of industry, to financially articulate what their projections are going to look like. And we all know when you're selling the business or when you're raising capital, the ability to articulate your forward performance and defend it is super important. So we're seeing, because of the uncertainty around the restart of the economy, the timing, et cetera, in almost all cases, we're seeing if people were thinking about M&A, they're pushing those off to the back burner. Deals that are in the market or that were in the market as the pandemic hit, it's really been catch as catch can. If it's an industry that is benefiting from this, we're seeing good activity, but we're seeing a lot of deals also that are just getting put on hold. And I think that's, from an M&A standpoint, I don't think that's surprising. And then, Scott, you had asked the question just about kind of bank financing and, what is it that the bank is looking at in terms of lending to customers, prospects. The big thing near term, of course, is the economic stimulus measures that have been enacted through the SBA. Everybody's expert on those acronyms now. So we've been real busy. We've been real busy assisting our entrepreneur, business owner customers navigate those programs and working with them on getting their applications in. And that's been a major focus for my colleagues on the lending side.
Got it. Okay. How do we step back and look at the allocation for each of you? Because we've talked about new investments in the hot areas and the hot markets, but we've all been making investments. My guess is for a decade or more, and the portfolios that we actively manage aren't all healthcare. They're certainly not focused on COVID. And so, when you start thinking about the next dollar you put out, are you thinking first and foremost existing portfolio, make sure they're secure, and then bring in new investments? Are you looking at bringing new investments because some of the company? I want to get a sense for your use of old, investments in new investments versus old investments. Donna, you have dual hats. You have both an angel hat and a VC hat on at the same time. How do you think about it?
Yeah, well, I can say so. For Robinhood, we've gone through the portfolio. I mean, I think similar to Ben Frank and everybody else, talking to portfolio companies, looking at contingency planning. So we kind of have an idea about who's going to need funding so that we're not stuck in this who comes in first kind of thing. So we're really okay, what does the portfolio look like? So we're having a lot of conversations around that and with our members. So I would say maybe similar to Ben Franklin, maybe we have 30% or something that will probably need some funding. And the other ones have, we think are in okay shape. I'm not, we'll see how long this goes on, who knows. And there is still interest among our investors to do additional new deals. And so, yesterday we looked at some tech deals, which doesn't have anything to do with COVID, but it's a digital approach to a financial service kind of thing. And, so I think it really depends on the deal. And when I was saying we're being more selective, obviously, I do see that. I think because I've had a couple of conversations with entrepreneurs who we were in the process of doing due diligence and kind of negotiating term sheets. And I think they haven't quite adjusted expectations yet, to this new world. So I do think, deals that we are looking at, people have to be really realistic about terms, I think. And I think, I had an entrepreneur talking like they didn't want to have, they were very concerned about valuation because they're concerned about, an A round 24 months out. So I said to, that's just, we're investing now, a very risky time. That's not, that has absolutely no relevance to us or any kind of investor, and you need to get off that. So I think, looking at, I think deal terms need to be much more tightened and valuations significantly more realistic.
And QJ, are you saying the same thing? Values down, terms tighter. Have we started to get back to the .com era where liquidation preferences get thrown around like there's no tomorrow?
Yeah. So why don't you take a crack?
I don't think I see the severity yet. Again, maybe a false positive because we're 100% looking at healthcare. But when I compare what we're seeing to what I'm reading about and what's being signaled by generalist venture funds that are industry agnostic, we seem to be somewhere in between zero and what the industry is, the venture capital industry is signaling. But we also just seem to be, because of what we invest in, relating to the situation differently than most funds. And probably our biggest example is we've accelerated based on requests from current LPs and new LPs. We've accelerated the fundraise of our next fund by a quarter. So in the midst of this, we thought, we should probably go out and raise our next fund sooner, not on schedule or later. So there's this demand. So the supply demand thing is a little nuanced when it comes to looking at our portfolio companies. I think we've done the textbook thing that everybody's done, which is we've gone through and done an internal audit of every single company in the portfolio to see where they needed to be, to see what they likely might need new in terms of financial support from the portfolio compared to the last time we did the exercise. And there's a few companies that, especially those that are, and there's a question in the chat that relates to this, especially those that are selling into kind of big healthcare enterprise. There's clearly a difference if your customer is running around, chicken with their head cut off kind of situation, and you just can't get the attention of the customer within the health system or the hospital or whoever is the enterprise customer you're selling to. That's going to set your sales cycle back, all things equal. We're just lucky that in a lot of cases, all things are not equal, because so many companies now in healthcare have almost ironically, a stronger value proposition today than they did 60 days ago. And that's almost offsetting the situation for them.
Q, did you want to add?
Yes. So I think, first, in terms of how much time we spend between existing versus new, I think, in general, most institutional funds are not able to cross-invest. So if I've got a Fund 2, which invested in Fund 2 portfolio companies, I cannot take Fund 3 money and save a Fund 2 portfolio company. Mm-hmm. I think that everyone should recognize that. Mm-hmm. So it means those discussions are separate, but at the same time, it's about focus time of the general partnership. We tend to spend more time nowadays on existing portfolio companies, like Donna and Jay said. I think the other thing to think through is, when we think about terms and term sheets, separate out people who are kind of tourist investors. What we have seen in the last 30 days is that the investors, I don't know how to define tourist investors, but I think you guys know what I'm saying. These guys will pull out term sheets at the last minute. The term sheet is there, the documents are being done, and they'll pull out. And this is post-COVID term sheets, etc. And the reason is they don't have the same network effects the regular VCs and angels might have. We want to remain credible next year, a year after next, and a decade from now, whereas the tourist VCs can take their bags and go away. So be very wary of people who have not done a significant number of seed deals or A deals and things like that. I would rather take a term sheet which has a few terms that you don't like than taking a term sheet from someone that has not done a whole bunch of deals.
Yeah, that is a very often short-term mistake, right? Which is the wrong investor at a better price rather than the right investor at the right price. And
exactly.
That comes back to haunt you later as you try to manage future rounds and more investors. I want to highlight, because I think a lot of the entrepreneurs on here, it's not just about accessing capital, it's the insights and the understanding of what it takes to get that capital. And if I'm hearing the panel right, what I'm hearing is valuation expectations are lower. To the degree it's lower also depends on the industry that they're looking at. And then the bells and whistles that are in there, I can give you one example, and I won't name a company name, but we had a company that wanted to do, because of COVID, they have a very big opportunity. They're generating more revenue. They're one of those in the portfolio that you look at and go, wow, like this really changes the dynamic for them in a positive way. Mm-hmm. And they wanted more company to expand, or more dollars to expand. And we said yes, but we agreed to do it as a bridge to a round that will happen at some time in the future. But I will say we put some aggressive terms in there that if they don't raise the capital to expand on that, that there is downside protection, there's liquidation preferences, in part, both because who knows what's going to happen, how bad it gets or how fast it gets better, either way. But also just kind of protecting ourselves that maybe the answer is, M&A, and that we want to have something that happens if they don't raise the capital. So I think from our standpoint, absolutely want to be there for all of our portfolio. We're unique in that we also have an economic development mission. And so having these companies survive and thrive is part of our goal. We as an investor want to make money so that we can support others and continue to push forward our mission. But I think that for the audience here, it's important to understand that valuations are going to be lower, and feel free to panel jump in here if you think I'm not correct. The bells and whistles are going to be more advantageous to the investor side, but there's capital there, and people are actively investing in new investments and old investments. With that in mind, I want to ask a quick question from one of our audience members about what does it take, and let me just to really get your interest? Are there specific metrics? Are there milestones? Is there something that a company can show to come in and say, hey, this is where we're headed. This is the pivot that we've made. And here's what we've already accomplished. In your mind, as you think about it, like, what does a new company need to break through and show? Are there specific things that a new company can break through and show that really gets on your radar as a new investment? Or is it just a sector?
Well, Scott, I think that question, at least the way we've begun to train our thinking, is around what is happening now. If the company is raising now and they have a COVID story, then how are they doing now that we've had? This is a little different than my answer would have been a month ago. But now that we've had, entrepreneurs think in terms of hours, days, and weeks, not months and quarters. So now that we've had a handful of weeks, in fact, I'm in the process of typing this answer right now into the chat box. But now that we've had I don't need to do that now. Now that we've had a decent period of time, is measured in entrepreneurial weeks, we can sort of start to ask the question, all right, how has your pipeline moved? And I couldn't have asked this question 6 weeks ago because nobody knew what the impact of the pandemic was going to have on their all-important sales cycle. But now I can ask, how many new deals were you logging into your pipeline? How many new customers were you getting out of the bottom of the pipeline in the 45 or 60 days pre-COVID? And how has it been now? Those are the kinds of things that, whether it's flattering data or not, we're going to ask those questions because that's going to give us a barometer of how impacted your business is by COVID. So keep tracking it. You need to understand that. But the more time we have in this COVID situation, the more fair it is for us to ask that question. And we've started to ask that question more actively today than we would have 8 weeks ago.
Okay, I'll just jump in and Scott, talk a little bit about. So, we've actually been thinking that we should not be over-indexing COVID because, some of these things are transients and we can't really invest in companies that are just getting a push because of COVID. It has to be a fundamental change when we come out 12 to 18 months out of this one. So where we are over-indexing is, has the management team seen through, let's say, a 2001 or a 2008 crisis? Are they coming in right off the bat and pitching a plan which will have essentially, with these funds, they can survive for 24, 36 months? Is this a founder that can do founder-led sales without relying on sales, marketing, hires? And are there pipelines wherever they're selling, based in ground truth, where we'll be able to call up the customers and more diligently do the pipeline analysis? I think that's it. We are not over-indexing on valuations either because, you invest at this is going to be a 20x, 40x, whatever. It doesn't really matter at these stages of the company, seed, A kind of stages. It's not, yes, you will see a little bit of terms here, but otherwise, I think it's more the later stage of companies which will see more of a valuation down.
Got it.
Yeah, I think, I think looking at pipeline is really critical. I think looking at cash burn and how they can manage and how on top of, contingency planning that they are. I do think, for early stages, often we're a bridge to an A, Ben Franklin, ourselves angels. And I think some of those deals got very aspirational, I should say. So I think what Scott talked about having, we've come out, we have to have downside protection. So kind of having these things where it's like a 20% reduction off an A round. And, so we need to have definitely downside protection and looking at those kinds of things. So I think those are definitively deals that are different. I think on the healthcare side, we want to see if have they really thought if it's something with some kind of COVID uplift, have they really thought about that? Have they gone in for emergency approvals, that kind of thing? So I think some of the things we've seen is a little bit winging it. So those kind of get pushed to the side. So I think it's like, do you really have a plan? Have you really thought about this through? And what does this look like? But I also agree that we're not investing in stuff that only has a COVID application. It's stuff that might get a lift from COVID, but overall is appropriate, for healthcare also. Outside and then tech and all the other stuff we do.
So we've talked a lot about the companies, I think, that have a great opportunity because of COVID, or the companies that their opportunity has clearly dried up. I call it the extremes. And for us, 60% of the portfolio isn't in that bucket. 60% of the portfolio is, yes, revenue has slowed, and yes, the market has gotten quiet on us, but our business is fundamental, and we will continue. And depending on how long is how long it takes for them to recover and get back on track. And so there's really two questions here. One is, do you kind of give those portfolio companies a pass on the revenue number? I think you kind of have to, right? Because this quarter or last quarter or next quarter is pretty much dead in the water. And so let's start with that. The first part of the question, which is, how much of a, for lack of a better term, free, get out of jail free do you have for the next, 2 or 3 quarters for your portfolio?
Scott, I was thinking about this comment just within the context of also like an M&A transaction. So how in our when we bring a business to market, investment bankers were really good at thinking of adjustments, things that boost up the profitability of the business. I think in this particular case, we're going to see we're going to see businesses that get brought to market or that look to go raise more capital. We're going to see a COVID-19 adjustment factored into the P&Ls. So that could be, to your point, maybe it's lost revenue. It could be additional burn rate. And I'm thinking in particular just about one of our clients who is tied into the in-person convention and trade show industry. So I was with him. I was with him over dinner maybe a month and a half ago, and it was the saddest thing I've ever been a part of. I mean, he was getting emails with conferences and things that were being canceled in real time as we were having dinner. But that business, when things open back up, that business will come back. And so when we bring that business to market for the purpose that that we were hired there, we're going to have some type of a COVID-19 revenue and profit adjustment in those numbers. So I think this is going to be very interesting to see how those adjustments get made and what investors and buyers think of those adjustments in the months and quarters to come.
Yeah. And, David, I want to come back to one of your points, which I think is for me, bouncing around of human behavior, because I think out of all of this, as we think about where we invest and how we invest, how does human behavior change because of all of this? And that's a bigger question maybe for another panel, because I think about my kids right now. I have 3 of them. They're upstairs on their computers. They're doing their homework, and they seem to be functioning quite well and quite effectively. And so I wonder about schools and universities and remote work and access. And so, JB, maybe we'll come back to this one for another panel. In the meantime, though, I want to come back to the question, your portfolio. So 40% of the portfolio, at least for us, is clearly impacted, better or worse. 60% is, the revenues are going to be off. What advice do you give to the company that isn't terrible, that isn't in trouble, that isn't skyrocketing? Is it don't raise capital in this market, wait and see? Or is it if you can get the capital, grab it while you can, because survival's everything? And so really the question is, how do you talk to your current portfolio that aren't in a desperate situation about fundraising?
Yeah, so I'll take a crack at this one. First, on the revenue side, you have to really segment the revenues. You've got to think through what is new revenue, what is expansion revenue, and what is existing revenue. on existing revenue, what we're telling our from a board perspective to our entrepreneurs is expect some churn on the expansion, 50% reduction, and for an operating plan and hiring perspective, push it out by 3 to 6 months. On new revenue, zero out anything in 2020, and then start from 2021. And then with this new model, look at whether you have the runway for 18 months or not. If you don't, raise. If you do, you could wait another quarter. But 24 months is a safety zone, and the closer you get to the safety zone, that's what we're pushing. It doesn't matter if you've got to open up a new round, if you got to take notes, if you've got to take whatever it is. Don't say no to capital. That's the job of you as a CEO.
So I'm hearing revenues. Expansion revenue is down 50%. New revenues near zero, and you need 18 to 24 months worth of runway as an existing portfolio, or think about a plan of how to get there.
And you got to combine that with your regular operating cost downs, which is reduction in forces, getting the contractors kind of out, going and negotiating with their landlord, going and negotiating with each and every of your software vendors, whether it's AWS or AT&T or Verizon, it doesn't matter. Do it.
Donna, does that make sense to you?
Yeah, I would say probably 18 to 24 months is a lot so I would say we're looking more at like 12 months, and I think the same thing. I think, we have to, this is unprecedented, where pandemic, everything got shut down. So, you're not going to have revenues, and we have to, accept that, and we have to look at where you were before and where hopefully you'll be afterwards. So I do think people have to be realistic, and we'll give people a pass. I think this is contingency planning, so we actually even have a team at Robinhood, so we're trying to look through that, help companies get as much cash runway as you can and be realistic. And I think if I had to, we have a couple of companies that don't need money per se, but want to have it. Like, so some of them are in biotech and some are in tech, and, they're going to raise funding. I personally think, if you can wait a little bit, I would probably suggest that. I think we're right. This has been a month, so we don't exactly know where things are. So, and I think, so I think it really also depends on your story about going to raise capital. But yeah, if you're in a good position, of course, it's easier to raise capital. It's hard to raise capital when you're desperate. That's like, investors never like that, because, it feels like a Hail Mary. So I think that's, the case.
And David, if you think about it from a banking perspective, do you have a window for these companies to sort of say, hey, let's not judge you in these 60 or 90 days. Let's revisit and realign? Because I have to assume what you looked at from a banking standpoint, in terms of the underwriting criteria, have been adjusted at least to give them a little more runway in what they said they would do.
Oh yeah, absolutely. My colleagues on the commercial lending side of the house have been working really hard these last few weeks, really around exactly that topic, which is, hey, you're an existing client of the banks. You have a certain amount of bank debt, right, that's on your balance sheet, and that bank debt is priced at a certain interest rate. It's got certain amortization terms, and in this dearth of revenue that many companies are experiencing, the expectation that you'll be current on making those debt payments at the same time you're going through, I think what Q mentioned, the reduction in force, the renegotiations with your landlord over lease terms. there's certainly been a realization on our part on the banking side that we need to offer our clients assistance and relief. So in essence, we're kind of my colleagues on the lending side are kind of adjusting their repayment and underwriting criteria so that our existing customers can have a little bit more cash runway in order for them to hopefully get through this and get back to maybe not revenue normal, but at least revenue positive and able to resume their debt payments.
Jay, I'll have you as anchorman here. So we've got 12 months, and I'll throw in my own commentary. For us at Ben Franklin, because we are seed stage, and most of these companies are trying to break into institutional capital by partnering with Ben Franklin and leveraging the support of Ben Franklin. And so 18 months is ideal, but in these scenarios for us, probably unrealistic. And so what is the time frame if you're going into a new round? Is it 12 months? Is it 18 months? You have the choice to step into a new investment. And what do you look at as sort of in the new world order as the minimum, to play, if you will?
You're
talking cash runway.
You're asking if we're evaluating a company that's new to our portfolio, how much cash do we want them to raise to get through X number of months?
I am. And if it's an existing portfolio and they're saying, I need more capital to do this, and you are intrigued, is there I would like to see us, when we go into a new investment, that they have at least 12 months worth of runway, especially in this market. But I'm wondering if even mentally, yep, go ahead.
Sorry. Probably a double standard, if I'm being honest, because if it's an existing portfolio company and they were in the middle of a raise, or they're now doing a raise sooner because of whatever pressure they're feeling. And we haven't talked about reduction in CapEx yet, but putting that aside, existing portfolio companies are encouraged, I think, as a lot of people are saying, raise what you can right now. You've got to survive. And we probably do have a double standard going for what we're comfortable with and participating in and advising our current portfolio versus looking at brand new companies. Brand new companies, I think that I'm thinking on the fly as you ask that question. It doesn't change a whole lot from what we would have wanted before. We wanted to invest into rounds before this all happened that were, at least 9 months of runway, generally a year to a year and a half of runway, depending on if all things hit right or all things didn't hit right. And that's what we still want. So the difference might be that the round sizes are going down a little bit because the company's not going to we're in the shadows of the Bay Area. So they may not have kind of that Northern California, get your burn rate up to $500,000 a month as fast as humanly possible. It's a little less of that mentality. So they might raise a little bit less in terms of dollars, but the runway is probably, just judging on 4 weeks of a sample size, the runway that we're requiring is probably about the same as it was pre-COVID. Just the dollars are changing because they're not going to spend quite as aggressively. They might hire 3 programmers instead of 4. They might hire 5 salespeople instead of 9. Some of those things might change, which means they'll have the same runway but require less dollars.
Scott, I'll give you a quick thing on a little bit more insight on why what I said. If you're giving a check of $100K or basically $500K, that's fine. If it's 12-month runway, fine, there'll be a write down. But think about an investor, an institutional investor like us that's putting in $3 to $5 million. Mm-hmm. If we have to write our value of an investment down in 24 months to zero and write it off, what do you think our investors are going to think about us? So when you're writing checks which are really meaningful, we have to require, just because we don't know how deep this crisis is going to be, we have to require that these companies last longer. Otherwise, we're not going to write $3 to $5 million checks.
Yeah, I'm a little surprised that, because I can tell you, having lived through as a VC in your chair in the .com era, we made the mistake of not watching, we made the mistake of not stepping back and saying, you know what, I know it isn't the aggressive way to do it, but we're not going to do anything for 3 months, 6 months, a year, and just see what happens. And this is 2001, where, yeah, you just would have been better off had you waited a year for everything. And so, what does it really take? I'm wondering how high the bar has to be to really jump into a new investment in this market. I mean, that's ultimately what this panel is about, of how do I get a new investor can I get a new investor into my company? Because either the opportunity is there for COVID, or the opportunity is dead because of COVID, or I need to change because of COVID. But that is the new world order. And so maybe just reflect for a minute, in terms of what will it really take if you're going to go in? I mean, for me, let's map out what a round has to look like, right? For me, it's at least 12 months worth of cash flow. Like I'm not jumping into a new investment unless there's a clear 12-month that that COVID, and regardless of the COVID status, that their business operates in a new world order as I understand COVID, right? And so fill in the blanks for me. What else is there? Is there a liquidation preference you're putting in there? Is there downside protection? Let's craft around for the entrepreneurs here of what a round's going to look like. And then as you think about that, if you want to jump into that, we can. I do have one good question from the audience, maybe just for Jay and Q, because Donna, you and I are focused on a region. I know Robinhood can invest anywhere. Ben Franklin clearly only invests in the Mid-Atlantic, and Fulton Bank is a super regional bank, growing aggressively, but really has a presence here. But Q and J, you have a more international, either from LA or the West Coast, or even J, your offices in Singapore. And so does the answers change for this outside the US? Does it change on the West Coast? Do you get more aggressive? Are you less aggressive? Does it matter? Or is this?
I think that I do think that it is largely as simple as you're generally speaking going to get less aggressive, except you might opportunistically get more aggressive in some segments of healthcare. If a telehealth company hits your desk this week, no matter what you were investing in 3 months ago, you're probably looking at telehealth, just to use that as an example, with eyes a little bit more wide open than you would have 3 months ago. Again, regardless of what kind of a venture fund you were. Asia, Singapore in particular, our operation there it's a complicated answer because it has a vibrant healthcare practice, but it also invests in a lot of non-healthcare. It also invests in Singapore and 11 countries not called Singapore. So it's almost going to depend on a country by country basis and how that country is dealing with or not dealing with the crisis. The one thing I wanted to throw into your question, though, and almost broaden it for the sake of not so much thinking about the terms that we might be looking for or the amount of runway, the one thing that we're really wrestling with, and I'm just curious if other people are feeling it, is now that we're this many weeks into it, we're wrestling with the one thing that is most compromised in our ability to look at deals is our ability to get to know the company. Just to put that out there, like it's great. We can debate whether or not we want 12 months of cash or whether or not we want this term added to the term sheet that might not have been added 2 months ago. But all of us are early stage investors, and all of us for years and years and years have touted how important it is to bet on the jockey, not the horse. Well, we can't get to know the jockey as well as we used to. And so I would encourage entrepreneurs to figure out how to compensate for that. We're working on a company in Florida right now, and it will be the first time in the history of our fund where we're making an investment without spending quality in-person time. Zoom is great, but Zoom isn't great. Getting to know the entrepreneurs. So how do you overcome that for VCs and other investor types who love to get to know the person or founding team when we no longer can do that? I can't shoot out to Tampa to spend a couple of days with this company. I can't invite them to Pasadena to spend time with my team. How do you overcome that important part of most of our decision process? At least we've claimed it's been an important part of our decision process for all these years. And now we can't do the one thing that is that important to getting to conviction. We're really wrestling with it, is how to overcome that inability to spend quality time with the team somehow, some way.
Rest of the panel, any suggestions? How do you bridge the personal gap?
I think what Jay is saying is very right.
I completely agree. Oh, go ahead.
No, David. Okay, let me add a very quick point and then we'll back to David. I think how do we bridge that gap? I think there's no magic. We used to be able to have dinners and long conversations in person. So what is a substitute for that? Well, come through if basically a seed fund has invested in you and they are the ones that kind of know you very well, that can be a substitute where, if it's Scott's company, Scott gives me a call and I'm not looking for a, rah-rah leader for every company that Scott has. Q, this is the best thing. You got to do. I think I want Scott to be realistic with me and say, these are the strengths and these are the weaknesses of this entrepreneur. And then I tend to believe Scott a lot more. So use your board, use your existing investors to reach out to A and be realistic about it.
Yeah, and I would just say that I don't have a solution for this at the tip of my tongue, but one of the other reasons why we saw so many in-process M&A and fundraising deals come off the table so quickly was exactly around this issue. There's a company that we were talking to that was in market that had a bunch of private equity and other professional investors that were interested in doing something with the business, but they can't host management meetings. They can't bring in buyers and investors for these sessions, and then the normal dinners or whatever other interpersonal things that people have been using. And when you think about millions of dollars or even hundreds of thousands of dollars changing hands over these transactions, getting this human and person-to-person element reconnected is going to be, I think, a major sticking point to getting us to the place that we all want to get to, which is resumption of pipeline and activity the way it was. But this is clearly going to be an important thing for everyone to wrestle with.
I mean, I agree, but I actually think there's an opportunity here, and I think seeing how entrepreneurs react under pressure like this. I mean, this is like extreme. So I think we've had such a bull market for the past 8 years that I think what we're seeing is like who's got the medal and who doesn't. So, and I think learning how to present on Zoom is very tough. We've had some great presentations and then some not so great presentations. So I think it's a new skill set. But I think part of it is on us. We've actually had a lot of discussion about this, and we think this is the new normal. So we have to figure out a way that we're going to do this. So we're spending some very extensive and a long time on Zoom with a bunch of different members. And so I think that's one thing. But I think seeing how entrepreneurs react, how proactive are they with, looking at scenario planning, contingency planning, how aggressive are they on talking to vendors, the whole 9 yards, can they manage that? I think that's also very telling.
I mean, yeah, what it really comes down to is in some of these situations, hard decisions are going to be made and the leadership is going to be the differentiation. Being able to make that hard decision, not only make the hard decision, but be right about it. Because if you make that hard decision and you get it wrong, well, startups can't recover from that. Mm-hmm. And if you get the right leadership and they make a hard decision and they do survive, they give themselves the opportunity to really thrive. Yeah. So I think that is probably what the biggest differential in terms of the ones that, the haves and the have-nots as we move forward of who is able to see how they needed to navigate, what they needed to do for that, and then they actually did it. Because I know of a lot of entrepreneurs, including myself, that are sitting there thinking about the actions they want to take and just not sure if it's the right action to take. and giving that the right amount of thought to come to the right answer is going to be critical. And so management in this scenario, it's easy in an up market. It's a lot harder in a down market. So that will be an interesting piece. So we have about 5 minutes left. I do want to make sure that that the messages and that the entrepreneurs that are reading to this get the parting words from each of you. We have one technical thing that I want to ask you about before we do, which is the new PPP, EIDL, and all the other acronyms that we don't all quite know. These are new programs, they're capital. We've encouraged all of our portfolio to apply for them. But there are rules, and we have struggled with some of the rules. So without getting too much in the technical details, because there are lots of panels to cover this, are the affiliate rules and these programs, are you encouraging your companies to take advantage of them in the U.S.? And if so, does it create issues for you as an investor?
So most of our companies are applying. Most of the companies are applying, but there is the 20%, affiliation rules that basically the way we've done is we figured that VCs are the best to exactly navigate the legal fine print. So the way we've done is, in a lot of cases, we've gone to, say, our general counsel of our fund and say, hey, look, can you give 15 to 30 minutes of free time to our portfolio companies? We've gone to our bankers and we've gone to the VP level and the higher level and said, look, you're going to spend 15, 30 minutes of your time because our portfolio company CEOs are sick and tired of reading the fine print and 50 pages when they have to actually figure out the sales forecast. So for them to speak that 15, 30 minutes to the humans who really know this is the best way to do it.
So leverage the expertise of your counsel inside, outside, and your VCs.
I guess we've seen, it's interesting because I guess we think there's some concern about affiliation rules, and it just seems like legal counsel to companies doesn't necessarily agree with that. So I think there's it's interesting. So we've encouraged everybody to apply, but we think on some of them they need waivers and they haven't, the lawyers said no. So it's interesting.
Yeah. I feel like it's the best sports team,
Yeah.
Truly. Yeah. No, I like this answer better.
Yeah.
So, Jay, anything different there, or David? Because now we're down to 2 minutes, and I want to make sure. One, I want to thank each of you for spending the time and participating on this, and for the entrepreneurs that are on the line and the Ben Franklin staff. Hopefully, this is helpful to give us a little sense. My sort of closing comment or closing comments would be: there is money out there. It is definitely looking at it with a finer lens, going in a little deeper and wanting a little more in terms of the return and a little more in terms of the security that round provides. And honestly, I don't think it matters in my mind, and I didn't hear differently from you. Yes, we're making new investments, but whether it's a portfolio follow-on or whether it's a new investment, have your ducks in a row. Be prepared that the round may not look terms and conditions like what you expected, from 6 weeks ago, because there is a new world order. But take the money and run, survive and thrive. Sometimes in VC or startup world, the company who wins is the one who's still standing. Mm-hmm. So that's my last word. I'd love if you guys, if you want, maybe just quickly go around if you have a final statement, and then we'll wrap it up.
Thank you, Scott, for organizing this. It was very helpful. I know I've not been able to answer some of the questions. Yasmin, you in particular have that. So if you want to share my email, Scott, happy to answer some of the questions. We have invested in, just before the crisis, a robotics company that helps in hospitals with respect to nurses and essentially nurse efficiency. So I'm happy to answer some of those questions offline.
Great. Thanks, Q.
I think my parting comment would be for the entrepreneurs in the room that are looking for a new round is just even more so than normal. Focus some extra attention on the funding announcements. Here on out, you will start to figure out amongst us who is still being courageous and who isn't. It's easy for us all to say we're going to slow down or we're going to speed up, but am I really actually funding new companies? Those usually find their way into the media or some database somehow, some way. So now that we've got a number of weeks in there, start paying attention to, just in terms of making it a more efficient and less frustrating process for yourself, pay attention to who out there is doing it. If Q's funding some companies right now, it'll show up. If I'm funding some companies, it'll show up. And in the absence of that, it probably means we're more shut down than we're letting on, in which case avoid those funds. But start to really focus, give your attention to the funds that are demonstrating they're still out there writing new checks, and deprioritize the others, because apparently no matter what they say on panels like this, they're not investing in new companies. So you can start to figure it out a little bit in the coming weeks, more so than you could have a month ago when there was really no data out there yet.
Watch what they do rather than what they say.
A little bit of that.
All right. Donna or David, any parting words?
I agree. I think, though, deals you are going to have delays in getting deals done. We are seeing that with due diligence. You can't do site visits, some of those things. So I think the process is a little more drawn out, even if you're doing stuff. So the ones that we're funding, we've been in due diligence and, have made some adjustments to deal terms. But as we're looking at new deals, we're seeing, we definitely want to do due diligence, and it might take a little longer.
Understood. David, you want the last word?
Yeah, sure. So first off, thanks again for organizing this. And I would just say that capital raising is a two-way street. It's always a two-way street, whether it's a good economy or a bad one. But there are issues and things that you'll need to do to continue to be moving the ball forward through this. Continue to rely on your trusted advisors to help you navigate, and everyone will get through this.
All right. Well, thank you again to the panel and to everyone listening. For those of you that didn't hear the commercial message in the beginning, Ben Franklin is launching a Slack channel to have some of these Q&A benefit from each other. And so watch for that in the coming months. And to Donna, Q, Jay, and David, thank you so much for joining us. Really appreciated the difference in perspectives, and hopefully it gives everybody on the call a little assistance as they move forward. So, and be safe.
Thanks again.